I'd have to think, we'll start with you, Peter, that trade is going to be top of mind for traders as we head into the G20. What are your expectations?
I think what we get is a giant can kicking. I think we back off. We say, hey, we made enough progress. We want to talk about this. I don't think we get a deal. I think there's too many serious implications with what's going on with Huawei, et cetera. So I think we're going to be tough, but pave the way for a future deal so the markets will be fine with that.
Matt, our editor-in-chief, Andy Sorwa, sat down with J.P. Morgan CEO Jamie Dimon, and he said or suggested that maybe President Trump should just walk away in terms of a deal. If they do walk away with nothing from the G20, what does the Dow do on Monday?
I think it'll get clobbered pretty hard. The market is pricing in, basically no bad news at all. We're up at all-time highs. We have a slowing economy. We have earnings estimates that are coming down, so again, I don't want to overstate this. I don't necessarily think we'll have nothing. I do think we'll get. I agree that we'll get probably a situation where they kick the can down the road. If that's going to be enough to hold up the market, that's great. But if we get zero, if we get a breakdown of talks like we got earlier in May, none of this negative news is being priced in at all.
Matt, you got my attention with clobbered, that's for sure.
I'm sorry?
You got my attention by saying it could get clobbered.
Oh yeah, I think we'll easily see at least 3 to 5%, not all in one day, but we'll get a 3 to 5% correction very quickly.
And where do you hide in a situation like that, Peter? Where would you put your money, or would you just take some money off the table and wait this thing out?
I think if you're worried about markets getting clobbered, you have to be in treasuries. I think we've learned last week that the Fed has changed kind of their reaction function, and they may be slow to put on the brakes if the economy does well. If we walk away with, a breakup on deal, expect almost emergency, talk about emergency rate cuts, et cetera. I think the Fed is well aware of the risks of tariffs and no trade deal. So I think that you're going to be protected there, and I think treasuries would rally on that. I don't think that's going to be the situation, but that's probably your safe bet.
Peter, I know you watch these markets like a hawk. So I assume you watched the Democratic debates last night. What do you think? So you're watching them on the stage. It sounded very anti-business. What were some of your thoughts?
Yeah, I think this is going to be one of the risks we face coming into the market. First, I think it's too early to tell who's going to win, so we're not going to react to everything that's said. But as we start looking towards 2020, you go out there, you talk to a lot of companies, there's a lot of political uncertainty. At one time, back in the day, the U.S. had a very clear roadmap, right? Here's what companies were allowed to do, and if at the end of that road you were successful, you were rewarded for that. We're seeing that roadmap change, and then there's more and more talk, which I think is frustrating, is if you're successful at the end, it may not be yours.
70% tax, that would be significant.
I think that would be very detrimental. I think we could see a shift where companies, again, start picking up and leaving the U.S. if they need to. Some of the big global companies, why would you sit here if you're going to be treated that way?
Yeah. Matt, you said that the market is probably a little too overly optimistic about trade, but what about the Fed? Much of the market now baking in perhaps 3 rate cuts. What's it going to take for the Fed to move that aggressively?
Well, I think it's going to take 2 things. Number one, I think that the Fed they're very much data dependent, but they're also very much market dependent. So for them to move very aggressively for 3 rate cuts, I actually think the stock market's going to have to go down. They would react just as much to the market going down as they would to the data going down. And that's one of the things that I do concern a little bit. I do agree that we have the Fed has certainly become much more dovish in their talk. They haven't done any actions yet, but that does look like they're going to be cutting rates. But we have to remember that cutting rates is not the same as QE. It's not the same kind of direct liquidity, a direct accommodation that's put right into the markets, and it doesn't have the same impact immediately. In fact, usually when you get the first rate cut of a rate cut cycle, the market tends to go lower initially. So because the economy is slowing. So
right.
We just have to be a little bit careful about that.
Here we have the opening bell at the New York Stock Exchange and the NASDAQ. We saw the Dow and S&P hanging near the flat line. The NASDAQ, though, was having a pretty good morning in the pre-market. And it looks like the Dow Jones Industrial Average is going to start the trading day slightly lower, at about 11 points lower. Peter, if things don't go our way at the G20, if more tariffs are implemented and this thing really gets ratcheted up, in an ironic way, wouldn't the market have reason to rally? Because then the Fed will come to the rescue with these aggressive rate cuts.
Right. So I think we're going to have relatively little impact from this weekend. I think we're going to actually see volatility decrease. What I'm really watching for is what's going to happen to the other 18 countries there, right? This whole focus has been, the G2. What are U.S. and China going to do? What I'm really watching is what's the rest of the world going to do? If the rest of the world gangs up on China and says, hey, we've all had enough of these unfair trade practices, intellectual property theft, backdoor hacking. If they get behind us, I think the markets can actually really rally, because then you get this global show of strength against China, which I think China will have to cave to. If the rest of the world kind of leaves us on an island, and we've seen that happen at some of the past summits, then I think the market impact's much worse, right? Because then you take that risk that, hey, the rest of the world starts ganging up against the U.S. I don't think that's the case. I think we're actually going to see Trump consolidate and get some of the other countries to support us anti-China. That would be good, even if we don't get a deal.
I mean, switching gears a little bit back to the debates. Listening last night, you really get the sense that the Trump corporate tax cuts are going to be waved goodbye by if a Democrat does take over the presidency. What are your thoughts on that?
Well, yeah, definitely. The one thing that if a Democrat takes over the presidency, I also think there's a very good chance that you'll have a sweep. In other words, where they take care of both houses. And if that takes place, I don't think we'll see they talk about 70% tax rates and stuff on individuals, and the tax rate for corporations going up. I don't think it'll go to 70%, but it'll go much higher, and it will definitely move up for corporations. So that's going to be, especially when you hear this rhetoric about that they're talking about taxing the rich and going after corporate America and Facebook and et cetera. It's going to be very bearish for the market. Again, it's very important to know where the market is when we get to the election. If it's flying high and the Democrats take over, you got a lot more risk to the downside, because everybody was worried about Donald Trump being very negative for the stock market. The market came in a little bit, and then of course it rallied very strongly. But if we're still up near all-time highs and the Democrats sweep into Washington, that's going to be quite negative.
Yeah, I think one of the things, people are being a little bit short-sighted about the tax implications. When you look at, yes, a lot has gone to share buybacks, which, I'm comfortable with. I think a lot of companies should be. But what I think are missing is certain industries are actually starting to invest that. And we've come to this world where, hey, on December 31st, 2017, we've given tax breaks. You're supposed to build these plants tomorrow. The reality is, if you're trying to build a large chemical plant, 500 million, it takes years to get the regulatory approval. So I think we're actually starting to see signs in certain industries of that investment that we're looking for. It's just going to take longer to play out, and it's going to be industry specific. So I think the rhetoric's got ahead of itself, and we should be taking a look, what's the energy industry? What's the chemical industry doing? Where is that investment coming? And be a little bit smarter about this, rather than just saying, hey, a few companies have benefited doing share buybacks, which again, I think are totally legitimate.
Perhaps corporate America just doesn't do a very good job of getting of that messaging, right, with what it is they are doing with their money. But you mentioned energy. We can't forget that we've got the G20 going on, but we also have all of these issues now with Iran. We have crude oil bumping up against $60 a barrel. What's your outlook on energy right now, Peter?
So this is one thing we're really lucky. At Academy Securities, we work with 13 retired generals and admirals who serve as our geopolitical advisory board. And so we view that we've underestimated the risk of escalation, either purposeful or accidental, in Iran. So we've been kind of positive on energy. We think oil prices are going to go higher. Brent's going to lead the way. WTI will follow. We've liked the energy companies. They've underperformed for a while. So again, I kind of tend to like that, because I think we could see a little bit of a catch-up. So we're kind of been focused on that. The other thing that we're seeing, again, ties into what I was saying about the G18. We have to consolidate around Iran and get the rest of the world backing us to stop kind of their nuclear proliferation risk. So these are all tying together, I think, very nicely for us to get allies out of G20.
Matt, make us some money in the oil space.
Yeah, I think I agree with Peter. It's interesting because one of the things that President Trump was talking about a while back was when oil got high, he was like, started to say that he was worried about how it would affect his core base. But you also understand his core base is very dependent on the jobs that come with the energy sector. So I don't think he wants oil to go a lot lower, the way some people think it does. So that helps as well. But you're looking at some of the stocks. You look at the technical aspect of crude oil. You guys mentioned that it was bumping up against $60. It breaks above that, it's going to break out of what's called a symmetrical triangle pattern. That's very bullish for the commodity. And we also have key stocks that are looking very good. Conoco was upgraded yesterday. Stock had a nice rally. It's bumping up against the top end of what's a descending triangle pattern. And if it breaks above that, That's very positive. And then one last stock is that Schlumberger. Here's a stock that has been just a horrible performer for 5 years now and made a nice little double bottom recently on a technical basis. So if it can see some more upside follow through, then we don't only have areas of the broad multinational oil companies, but we also have the oil service companies starting to do well. And Schlumberger has been one that's been a dog for a long time. If it can finally rally, that's going to give the group momentum and a lot of investors a lot more confidence in the group as well.
Peter, so I've been keeping track so far this week. FedEx, not good results. General Mills, no good. Conagra this morning, no good. I would even say Walgreens this morning wasn't good. What is that telling you about the economy?
I don't think it's telling us a whole lot. I think Q1 was overstated in terms of the growth. Q4 last year was understated. So I think we're just having these kind of bouncing around. I hate to kind of be one, here's the trend and now it's set. I think we're going to have to wait and see. It's really going to be dependent a little bit. Do we come out of this trade well? And we just had the Fed really coming out dovish. So companies haven't had a chance to respond to that. So I'm not too concerned. My outlook for the rest of the year has kind of been, this 1% sort of growth. So subpar growth, but still growth, not recessionary.
What about you, Matt? Well, talk has reared its ugly head again about an earnings recession. Do you believe there's any truth to that?
Well, I mean, for a technical earnings recession, we have to have 2 down quarters in a row. What it looks like we're more likely going to have is a lot of really low quarters in a row. I mean, everybody was looking for the first quarter to be negative and eked out a slight gain. Now we're looking for the second quarter to be slightly negative. And then, of course, we always beat expectations. We do have that every quarter. Looks like we're going to have a slight gain. But now even the third quarter, the estimates have now gone slightly negative for that. And then even the fourth quarter, which was supposed to be up 10% earlier this year, everybody is now that's gone down to the 5 to 6% range. So these earnings estimates keep coming down. It's a big concern. So that's why it's vitally important that we get some sort of a deal coming out this weekend, because if we kick the can around, down the road too far and nothing is resolved, you're going to have a lot of corporate executives saying, we still don't know what to do. There's still too much uncertainty out there, and we're not going to get a pickup in earnings that would justify the level of the stock market right now. So I know I've been talking quite cautious, but we really need something out of these trade talks, more than just a kicking of the can down the road, in my opinion.